Okay, this is Professor Azera, and this is the third of the videos on biotech. The first two were theoretical, and they're just meant to give you a general idea of the importance of having different drugs, especially blockbusters, uh, either in the market or at late stages. Although good companies have drugs at all three stages of production. So that's what those two videos were about. This one is about a valuation. This is the model valuation that I'm going to give you. And what I'm going to end up doing is we're going to end up doing a valuation for this very same company, but for a more recent year. Okay, so let's get started. Okay, so what I'm going to have you do, and I'll see if I can send you a sheet. It's already kind of pre-made, but there's the balance sheet here. And to the left of the balance sheet, I want you to insert, I will want you to insert two sheets. One says justification of growth rate. The next one is a pro forma valuation. Okay, and I'm going to take all these things out. I already did it. I already practiced one time because these types of valuations can be a little complex, but it turned out just fine. Okay, so so in the justification of growth rate, given based on the theory and all that, I came up. We're doing the valuation for a company called Gilead, and the base year is going to be 2015. Okay, and so I use 50% growth rate based on the analyst estimates back then. The class has been looking at this company for years. Okay, and at the time in 2015, the company didn't have a big pipeline. It was considered kind of not a good stock at the time, but those times could be changing. So I'm going to have you do a valuation with a base year of 2019 for this company, following the model I put in here. But in this justification of growth, give me 3 or 4 things: the analyst estimates, whether the company has any products in market that could expand, if it has any promising stage 3 blockbusters that would increase its growth over the next couple months or even next year, let's say. Okay, let's start our pro forma valuation. This is the model I want you to use. We're assuming a 2-stage evaluation, super growth, 15% growth. That was what it was supposed to grow out by back in 2015, 8% cost of capital, and these two things right here. Okay, so let's start with the income statement. And the income statement, what I'm going to do is we're going to have a percentage column here. So we're going to have a percentage column there. And our base year is 2015. So I'll write it here, base year 2015. And then we're going to go out 5 years. So 2016. Yeah, I know I could pull these out. Let's see if we can. 2017, 2018, we'll go all the way out to 2020 there. We got 5 years. Okay, and what I'm going to do, just like I did in the other valuation video, is I'm going to bring over all the items on the income statement, and then I'm going to do the same thing for balance sheet right off the bat. So here's our income statement. Let's go over to the statements of income, and our base year is, we're going to start with revenues. Our base year is 2015, so that's going to be our December 31, 2015. And we're going to go all the way down to the income. I don't want any diluted in there. I just want the basic. So we're just going to go down to the shares used in the basic computation. So we're going to take those things and copy them over to our pro forma valuation. Okay, and I'm going to move these numbers. I'm going to go ahead and move these numbers over to the 2015 column because we're going to put percentages down here for all these items. Okay, and then let's go ahead and get our balance sheet in here too. Okay, so our balance sheet will come in right there. Balance sheet. Okay, and the balance sheet, I'm going to go ahead and just bring down the years to make it easier to know which years we're working with. So go ahead and copy those over down here. Okay, and I'm going to go ahead into my balance sheet, and like I've been doing, I'm going to go ahead, 2015 is our basic year, and so I'm going to copy all the amounts, the titles, and the December 2015 items over. Okay, and so we're going to go over here to the pro forma valuation, copy these titles. These financial statements are not the best. I didn't put them together, the company did. Okay, but anyway, so we're going to take these numbers here and I'm just going to go ahead and move them over to 2015. Okay, I did that for both because for both, the first column is going to be as a percentage of total revenue. And let's see if there's something I got here. Well, that turned out fine. Okay, so anyway, so let's go ahead and compute our percentages. And keep in mind that everything is a percentage of total revenue. That's how valuations have traditionally been done. Okay, so the total revenues are 32,639. So I'm going to take that. I'm going to take C16 and divide by itself. Then I'm going to go ahead and freeze the denominator. So everything is going to be a percentage of total revenues. Now this company, their total revenues are products, their basic revenues are product sales. And they have some contract royalty and others. So I'm just going to go ahead and copy this formula up to there, and we'll copy it. I should just copy it over. Okay, so 98% of the revenue comes from product sales, and the royalties constitute about 1.5% of sales. Okay, and then I'm going to go down here and copy the formula for all their expenses, and I'm going to do that through net income. Okay, so I'm going to do that through net income. Okay, and then I'm going to do the same thing for the balance sheet. I'm going to just take any one of these formulas that were used, that I calculated the percentages from on the income statement, and just run it all the way through the balance sheet. So for some things, for some small things, it's meaningless, but okay, but it'll work for them. So I got my percentages down. I got that. Okay, now I'm going to assume that both types of revenue are going to increase in the super growth period by 15%. Okay, so for this particular, for the revenue items, I'm going to take the revenue item for product sales. I'm going to multiply that times, in parentheses, 1 plus the growth rate. Okay, and so that looks like about 15% growth for that. I'm going to go ahead and freeze the growth rate. And then we're going to make that out there. That looks pretty good. Okay, and I'm going to assume, let's see if we can just copy these down. I'm going to assume that the product royalty and everything else is also computed that way, and this corresponds to some of my numbers. Okay, now keep in mind that there's two cardinal rules for this. All subtotals should be calculated as subtotals. So we'll put subtotals here. I'm just going to give you, I'm just going to indicate where these are coming from. And so any subtotal should in fact be a subtotal. And any individual expenses and revenues, any individual items will do using that formula, the magic formula or whatever. Okay, so total revenue for 2016 is 37,535, and we will copy 37,535. I'm just looking at something here. I must have missed it. Okay, so we will go down here, and there's your subtotals. Okay, so we have about $64,000 in revenue right there. Okay, and 57,086 right there, 49. In 2016, we have that amount right there. Got it, should be correct. 43. Okay. Okay, so we look good there. Okay, now for all our individual line items, subtotals always have to be subtotals, and for all our individual line items, you know, there's the formula that I showed you in the first valuation that you're going to turn in a couple of days, and in that one, you're taking basically, we're going to do this. We're going to take the cost of goods sold. We're going to take our sales and multiply that by the percentage of sales which cost of goods sold constitutes. So that should give you about 437 right there. I just want to make sure I'm taking, no, let's do it like this. Let's change this formula to is equal to total revenues times costs, the percentage of cost of goods sold, and we get 4607 for that amount right there. Okay, now if you put the dollar signs in the right place, which is in front of the 16 and front of the B, you should be able to copy horizontally and horizontally, and then as we go along, even vertically. Okay, so I just want to check one number here. I want to take 8057 and divide it by 65,000. And you'll notice that I do get 0.1227 and 0.1227. I do that just to check myself sometimes. And I'm just going to call this the key formula. I forget what I called it last time, but that's the formula which is going to allow us to just copy and paste a lot of these things. Okay, so we've got cost of goods sold, and these next two items, R&D and administrative expenses, are one line items, both reasonably based on your percentage of sales. So we'll take those as a percentage of sales also. Okay, so I just want to make sure that they're correct, and so they do look correct. I'm just going to take this number and divide it by 65,649, and that gives me 9%. So that checks. And then I'm going to take this one too. I'm going to take this number too and divide by 65,649, and that gives me 10.5% more or less. So it looks good. Okay, I'm just checking because I'm not going to do it for all of them. Okay, now the next item here is a subtotal, which is your total costs and expenses, which is going to be your cost of goods sold plus your R&D plus your selling general administrative expenses. That's going to give you 12,403, and that's a subtotal. That's a subtotal right there. So I'll try to bold the subtotal. So just copy this over here, and we've got that. There's our amounts right there. Okay, now just to indicate, we use the key formula for those individual line items, and this was a subtotal here. Just trying to give you an idea of how it comes. Now your income from operations, that's also a subtotal. Your income from operations should be equal to the total revenues minus your total costs and expenses. So our subtotal for 2016 is 2522, and then that's our income from operations before interest. Okay, and so those are subtotals also. Those are subtotals also. Okay, and now let's see. I'm just for my interest expense. So this is income from operations. We're going to subtract out interest expense, and we're going to put in small amounts of other income. Now I'm just going to leave these two items constant because I have no idea what this company's financial strategy is. First of all, they're pretty minor right now. but also I just don't know what their financing strategy is. Once you did know, you could make more. You could make them add to the model. You always add to these models and take away and constantly tweak them. Okay, so we've got those two things are not subtotals. Those two things are constant. Leave that constant. And this number is also constant. Now the provision for income taxes, I'm just going to go ahead and use the key formula for the subtotal. I'm assuming that provision for income taxes is a function of sales. It is to some extent. Obviously, it's also a function of expenses. I'm just going to assume it's a function of sales. Oh, excuse me. That's incorrect. This is actually income before provision for income taxes. This is actually a subtotal. Shouldn't have used that. So anyway, so this is going to be income from operations plus the interest expense plus the other income, which is going to give me 24,988, and I'll just move that down, and that is a subtotal right there. So that's looking pretty good. Okay, so that number is a subtotal there, obviously. Now, this is what I was saying before. For the provision for income taxes, I'm just going to go ahead and use the key formula. I can take any row for which I used it and just copy it down. And I don't think this is unreasonable. If you look at, first of all, I'm saying income taxes is a percentage of sales. This first year doesn't look unreasonable. It's about 20% of that. But I noticed that since our sales are probably going up more than our expenses, so this year the effective tax rate does go lower. I'll just keep that, and you could change it. You could make, that's another tweak you can make. Okay, so our net income is going to be income before provision for income taxes minus, notice I didn't use pluses minus signs to these statements, 4086. So for that I get 20,902, which is fairly reasonable, and use that number right there. So I used, initially at least, I used the key formula here, and this was a subtotal. Okay, and my last number there matches with what I have in my sheet here, so that looks good. Okay, and I don't know net loss attributable to non-controlling interest. I should probably hold that constant. It's so immaterial anyway, it doesn't matter, so I'm just going to make that 0. Okay, and I'm just going to say constant, keeping it a constant 0. And then the net income attributable to dry lead is a subtotal, and it's just the net income plus your net loss attributable to non-controlling interest. Net loss. That's really not non-interest, minority interest income, or non-controlling interest income. Okay, so anyway, these are subtotals right here. Those are subtotals. Okay, and looks pretty good so far. Okay, and our earnings per share basic, our earnings per share, I'm going to assume that shares don't change. Like I said, I don't know this company's financial reporting strategy. And what I'm going to do is for net income attributable, for earnings per share, I'm going to take net income attributable to Guy Lead and divide by shares outstanding. Okay, so hell is that? Is equal to 20,000 divided by 1,400. It's going to be earnings per share of $14.28. And moving out, it should grow a lot. So my final earnings per share are $25.54. That looks pretty good. Okay, and so now let's go down to the balance sheet. Okay, I've got all these current assets. So I've got all those current assets there. And I'm just going to make the assumption, for simplicity's sake, that all the current assets correlate with sales. That's true for cash. That may not be true for more short-term marketable securities. They may or may not. It's more of a investing/financing strategy. Accounts receivable would, inventory would. I'll assume these two do. So I'm just doing this to to make it simple. And most of those assets, at least for cash, accounts receivable, inventory, are definitely candidates for correlating with sales. So these are all going to be the key formula. And I'm just going to take any number. I can take any row, which I use a key formula for, bring it down here. And then I'm going to go ahead, and there's my current assets right there. Okay, and yep, that looks good. And obviously, total current assets is going to be the subtotal of these right here. So total current assets is going to be the sum of cash going through prepaid assets. Okay, and bring these down here. So that's a subtotal, obviously. Those are my total current assets. Oops, I did something silly there. Okay, and we will copy those across right there. And we'll put a little line there. This is a subtotal. And so I just want to indicate that this is a subtotal here. And remember, either use a key formula for individual line items. Subtotals should always be as subtotals, and some items you can just hold constant. Okay, now property, plant, equipment, net. You always keep that as using the key formula, because property, plant, and equipment net definitely corresponds with net income, maybe revenue, and free cash flow. This makes sense. So always use the subtotals for that. So there's my predicted property, plant, and equipment. Okay, that looks good there. I'm just checking out some general numbers to make sure I'm going in the right direction here. Looks good. Okay, and then the long-term portion of prepaid royalties, I'm just going to keep this constant. And that maybe doesn't make sense because I was raising the royalties above, but I'm going to go ahead and keep this constant. Like I said, you can always do some investigating and tweak these things. Long-term deferred assets, I'm going to go ahead and keep those the same. And I think what I'm going to do is, for all these long-term assets, and especially for goodwill, I don't know their acquisition strategy. I don't know that much about this country, but I'm going to hold all these constant. It's going to make my life easier. Okay, and this is just the first cut at the model. What happens is you make the first cut, and they're going to make some changes, both minor and major. But this is the first cut at the model, and this is the model that I'm going to want you to use for evaluation of this company for a base year of starting at 2019. Okay, so I'm just going to put here, these numbers are all, I kept them all constant, and properly planned equipment was using the key formula. Okay, so my total assets, let's get some number for some total assets. Total assets should be total current assets plus the sum of your total non-current assets. Now, you should observe that this company has, actually, if you go back to the income statement, they actually don't have a subtotal for gross profit or margin, and they also don't have a subtotal for total non-current assets. So these statements can get on your nerves a little bit. Okay, so those, if I take my total current assets and add to that my total non-current assets, I should get my total assets, knowing that they don't even give me a subtotal for. Okay, so that looks good so far. Okay, then we're going to come here to current liabilities. Now, I'm going to use the key formula for, I'm just going to go ahead and for all the current liabilities, I'm going to use the key formula. I'm going to assume that everything is a percentage of sales. That probably applies to accounts payable. It does apply to accounts payable. Other accrued liabilities, it probably wouldn't apply to current portion of long-term debt, but I'm just going to keep it that way. just to be easy. Obviously, you could, once I put in all these numbers and it balances, you could actually investigate their long-term debt and come up with some other formula for using it if you wanted to. But in this initial model, I'm just going to use the key formula. I'm going to consider these all a part of key formula. So I'm going to copy that all the way down to current portion over long-term debt. Okay. And then we will subtotal the total current liabilities. We'll make a subtotal there. So this is equal to the sum from accounts payable to current portion of long-term debt. And I don't know why it keeps doing this, but I'm going to have to just go ahead and do that again. Equal to the sum of those items right there. So that gives you 11,735, 11,735. And so we come out here and you've got the final year's total current liabilities are 19,784. I'm just looking at this for a second. Going down here. Yep, 894. That looks good. Okay, I'm just checking with a version of this I did a few minutes ago. Okay, what I'm going to do, and so all these items here I obtained by using the so-called key formula. Okay, and all these items I got by using the key formula. Some make sense, accounts payable. Maybe this one, accrued government, other liability rebates, could be having to do with Medicare and other current liabilities. I don't know if unearned revenues or the current portion of long-term debt would apply, but you could always tweak it later. Okay, now let's go down to non-current liabilities. I'm going to use the key formula for non-current liabilities, but ultimately it's going to be my plug. Okay, so let's just go ahead and use the key formula for that item, but that's going to change because I'm going to use it as my plug. I'm going to get some huge negative numbers here. And for income taxes payable, so for income taxes payable, I'm going to hold those constant. That's long-term taxes payable. I'm going to hold those constant. I'm going to hold everything else constant almost from here on out. Long-term taxes payable. These two items, I'm just going to go ahead and hold constant. You know, when it comes to long-term things, you'd have to do some investigating. So this one is constant. These two are constant. And constant things are usually either incredibly immaterial, you don't care, or you just have to do some more investigating. Okay, so temporary equity. This is the equity component of notes receivable. I'll keep this as $2, and I'll consider that to be equity, you know, the old debate. So that's constant too. So this formula here is constant. Okay, and the preferred stock, well, just for posterity's sake, 0 anyway. We've got some authorized but not issued apparently. Common stock. I'd love to really study what they're doing. $1 common stock. They've got they've got a par value that's so low. They have a lot more additional paid-in capital than par value. I'm going to keep additional paid-in capital the same. This is consistent with my assumption of buffer earnings per share that they're not going to issue any more shares. Okay, I'm going to keep my AOCI constant. So my AOCI is going to be constant. Okay, and retained earnings is a subtotal. So this is going to be a subtotal. Or my last subtotal. This is actually a subtotal here. Okay, and so in a sense, my retained earnings is going to be a subtotal. My retained earnings are going to be just the beginning retained earnings plus they're going to be is equal to beginning retained earnings plus your net income. And actually, sometimes retained earnings are used as a subtotal, as the plug figure, because you assume they're paying dividends. But right now, we'll just put it into long-term debt. Okay, so it's going to be beginning retained earnings plus my net income. So my ending retained earnings 5 years out is, and this will go down, is 159,860. Okay, and so let's see here. I'm just looking at some things. Seems to be on the right track. I will leave it like that. Okay, so our total shareholders' equity is, it's going to be the sum. It's going to be the sum of, I'm going to go ahead and include the temporary equity and shareholders' equity. It's so small. Who cares anyway? Sum of everything here, including retained earnings. So your total shareholders' equity, what am I doing with it? It includes, well, no, I think I'm right there. Let's stretch this out here. Let's go ahead and extend this. And so it does look like there's your total shareholders' equity is that amount right there. Now, you've got a non-controlling interest. So this is a subtotal. Equity is a subtotal. The non-controlling interest, I will hold constant. It's so small anyway. Like I said, who cares? And then your total shareholders' equity is going to be your total equity that is owned by Gilead shareholders and your non-controlling interest. This is an interesting company to look at. So the sum of that plus your non-controlling interest will be your total shareholders' equity. And I'll just go ahead and extend that out. Okay, and then finally, your total liability and shareholders' equity is your total liabilities are total current liabilities plus the sum, it's your total current liabilities plus the sum of all your non-current liabilities, which are these three items right here for temporary equity. So those should be your total liabilities. It gets on my nerves that they don't have a separate subtotal for non-current liabilities, but they don't. So I'm just using this format they used. So those should be my total current liabilities. Bring those up. Okay, now I've got to add to that my total shareholders' equity. So that's my total liabilities. I've got to add to that my shareholders' equity, and this should give me the total liabilities and shareholders' equity. So we go from 51 to 56. Okay, so we'll see what we get here. And so I'm just going to go ahead and take this formula out here. We get 225 here, which is a lot higher than I recall that you get up here for total assets. So we've got to plug this number in and make sure it works. I'm just going to review my formulas now. Your total assets are equal to, I'm just going to look at the formula out here. D41, total current assets, plus all the non-current assets. So that formula looks good. Make sure my total current assets are good. It's the sum of those things there. That looks good. So my total assets are, like I had before, is the sum of those things. That looks logical. I want to just review this before I go into doing the plug. Okay, then your total current liabilities is some of those items right there. That looks good. Okay, and then we come to our non-current liabilities, which have no total. I could have put it in there, I decided not to. So our total liabilities should be, come down here. So anyway, let's go to retained earnings. Retained earnings is your beginning retained earnings plus your net income. And I just want to make sure this is correct here. Let's do this. Okay, I want to make sure that the first number is my income statement row, which is row 27. Okay, that looks good. See, that's 2029 is my net income. So that looks good. Okay, so we got that number right there. And going across, I just want to make sure it was all the way across. That looks good. Okay, my total shareholders' equity is the following. Is that number right there. Total guy-led shareholders' equity, I'll make sure that's correct, is these amounts here. That looks good. It's right, including retained earnings. So that looks good. It should be just over that amount right there. I want to make sure this is right. Is equal to the sum of that number and going to retained earnings. 39. Oh, it's 38. So that should be in the ballpark there. Okay, and total liabilities per shareholders' equity. Look at that formula. So there's your shareholders' equity, which looks pretty decent. Even if the balances are off, momentarily, that's going to be okay. Plus your total liabilities. So it's your total current liabilities plus the sum of your non-current liabilities, plus your shareholders' equity. So that formula looks good. Okay, so far our numbers look fairly decent. Okay, they grow by a lot here. Okay, and so now we've just got to take care of, let's just note that this is constant. This is a subtotal, and this is also a subtotal. Now let's go ahead and see what we can do with our plug. I did check those formulas over, so here we go. Okay, the plug formula, I initially used the key formula, but I'm going to plug this, is take your total assets and subtract out all your current liabilities, then subtract out long-term taxes payable, and subtract out other long-term obligations. And I'm subtracting them out individually because they have no subtotal for non-current liabilities. And then subtract out your shareholders' equity, which is right here, and that should give you a plug figure, and it changes to 55,895. With any luck, that will equal, it does. So I don't know if we dodged a bullet there, but that looks good. So the balance sheet will balance, and I'm just going to go ahead and where my plug figure is, I'm just going to take 2016 and copy that all the way over for the next 4 years. And notice we're getting negative numbers, and that's not really a problem. You can actually, if you wanted to put this on the asset side, you'd have increasing cash. What they're saying here is that you're paying off debt, or you could actually plug into retained earnings, because retained earnings, we just added income. You could say they're paying dividends. You'd have to look at their financing policy. So you could actually split it between one or more accounts. But anyway, the main thing for me in this initial model is in the last year, total liabilities and shareholders' equity is 79185, and that should equal my total assets, 79185. That's what matters to me now. Okay, now let's go down and take a look at our assets now. Okay, and so I'm going to write in, this is schedule, this is the trickiest part of all this, schedule of assets. And I'm just going to go ahead and note a few things. I'm going to have the gross assets. I'm going to have my gross assets. I'm going to have my depreciation expense I'm going to have my, and I'm going to put accumulated depreciation. I'm going to put my depreciation rate first. Depreciation, let's see what we can get here. Depreciation rate. And just to get it over with, I'm going to get my accumulated depreciation. I'm just going to put A//D for accumulated depreciation. These are all for 2015. Okay, my depreciation expense, I'm just going to get that from my statement of cash flows. There we go again with this thing. Okay, so I'm going to go over to my statement of cash flows, which is just three sheets over, and my depreciation expense is equal to, I'm going to include, no, I'm just going to include depreciation in there. You probably want to include amortization expense, depending on what you, that's probably has to do with patents, because I don't think they were amortizing goodwill because it's not impaired. Probably has to do with something that has to do with amortization of patents. And you would want to look into capitalizing the R&D, and the patents have already been capitalized. Okay, but anyway, so the gross assets, these next two items I'm going to get from a sheet, which is way out here. The gross assets, and this is going to be slightly off, and you'd have to tweak it out of here. But to get, there's a schedule way out here, way out here. Your gross assets are in a schedule. It's past the derivative tables even, the investment in derivative tables. And it's this schedule right here. Your gross assets, I'm going to say, are your gross property, plant, equipment. Now, this is wrong, I know. I'm going to say it's your gross property, plant, equipment plus your land. Okay, and the only reason I'm doing that is because it's right now, I just realized that the net property, plant, equipment on the balance sheet includes land. So I just want these numbers to equal, and then you go around and you tweak it out. Okay, so my gross assets are 3039. My depreciation rate is my depreciation expense divided by my gross assets, knowing it's going to be a little bit lower than it should be because I've thrown land into gross assets. Okay, and I believe that depreciation rate is, let's see what you get here. Getting these zeros out here. About 5.3% is your depreciation rate. And I'm going to get my accumulated depreciation here just to get this thing started. And unfortunately, the accumulated depreciation comes from that worksheet way out here. It comes from this amount right here. It's negative 763. Okay. Okay, now I'm going to make the actual schedule of assets. And the first thing I'm going to do is bring my years down so I don't lose track of my years. So we will do this. I'm going to bring the years down just to know what years I'm working with. Bring those down here. What the hell is that? I'm going to do it. Well, no, I know I did wrong. So we'll try it again. So there are my years. I'll go ahead and bring them down here. Oh, I'm not copying it as values. Good Lord. It was as numbers. Try it one more time. Very late at night, and I'm thinking very slowly right now. Okay, so I'm going to take this number and copy it down to here. Now I'm going to undo it and use paste special, and I'm going to use paste special and then values, and then we'll get the numbers. God, that took too long. Okay, so the gross, this schedule is the one where I get depreciation expense from, and other numbers from, and the capital expenditures from when I do my free cash flow. Okay, so my gross assets, the first thing I'll do is I'm going to say gross assets. It's going to be minus accumulated slash depreciation. Okay, unbold that. Okay, and that's going to give me my net book value of assets. Okay, so for 2015, I know that my gross assets were equal to 3039. I know my accumulated depreciation was 763. So the net of these is net book value is 2276. And the reason this is the reason I put land in there. I want this 2276 to be equal to my net assets, my net fixed assets on the balance sheet there, which is 2276. And I want to make sure that's equal to that number right there. And that's why I did that originally. Okay, now over here, I'm just going to come over and I want to make sure that my net book value of my assets is equal to the net book value of my assets on the balance sheet. Okay, and so that's what matters. I usually do a theory lecture in class on this. Unfortunately, given the events, I haven't been able to. Okay, and so those are my net assets. Okay, my accumulated depreciation should be my beginning accumulated depreciation. And I'm going to add to that my depreciation expense for the year, which is, so it's going to be negative 763 minus my depreciation expense, which is going to be the gross assets, or we can put it down here, the gross assets times the depreciation rate. And that should give you a slightly more negative number. It does. That looks good. Okay, so that looks fine. And then my gross assets are going to be the sum of these two numbers. So I'm going to do equals to 2617 minus, because that's a negative 924, minus negative is a positive. So minus 924, that number, negative 924. And that gives me those numbers right there. Those look pretty good so far. Okay, so what I'm going to do, I'm going to go ahead and copy these over to here. And that's going to give me, should give me those amounts right there. So, and they do look basically okay. Yes, they do. Okay, so now we're going to go down here and compute our free cash flow to the firm. Our free cash flow to the firm, the subtitles are going to be net income minus, this is going to be minus change in working capital. Then we are going to put in, we're going to add in our depreciation expense. So I'm just going to go ahead and copy this down. And then we're going to take out a minus capital expenditures. Okay, minus capital expenditures. We'll do this, oh, Jesus. Minus cap X. Good. Okay, our net income, we're just going to pull from the income statement. Let's go up. I want to make sure I got the right row here. Yep. And it's like line 27, I think. Yeah, line 27. So our net income is equal to whatever income we have in the income statement. Like I've been saying, this is a mini statement of cash flows. Okay. And let's do our depreciation and CapEx first. Okay, our depreciation expense for these 5 years is going to be, our depreciation expense is going to be the difference between that negative 924. I think I'm going to add this in 763. So, no, I should subtract it. So our depreciation expense will be the difference. It will be the $161 difference. That looks good between the accumulated depreciation. And we'll move this out here. Why is it giving me 0? Oh, because I have this number here. Oh, I forgot to put dollar signs. I forgot to put dollar signs in there. So that will change things around a little bit, but that makes more sense. What I forgot to do, the reason I was getting those bad numbers, I forgot to freeze this depreciation rate, which applies across here. Okay, so anyway, so those look good. Okay, our capital expenditures are just going to be one positive number minus another one, the increase in gross assets, except that we subtract out capital expenditures. This being a mini statement of cash flows, this would be like buying property, plant, and equipment. So I'll just put that in parentheses and make it a negative. Okay, and that number right there. And now looking back at this number I should also make a negative because we're adding back a state depreciation expense. So this number should also be a negative the way I did it. So you look at the formula. This is the formula I'm using. I make it a negative. It's a positive number. I'm making it. It's a negative number. I'm making it a positive by adding the negative sign. Okay, so I've got net income. I'll add back my depreciation expense and take out my capital expenditures. Now, change in working capital. Keep in mind that the change in working capital should be not include cash. Okay, and we know that assets always go on a statement of cash flows in the opposite direction of their change, and we know that liabilities go in the opposite direction of the change. So I'm going to consider the assets first, then add the liabilities. Okay, keep in mind that assets cannot include cash. So what I'm going to do is I'm going to start, and I'm going to start by taking the sum of all assets for 2015, not including cash, and subtract out the sum of all current assets for 2016, not including cash. And the reason I'm subtracting those out is because what happened there? Excuse my language. Okay, so we'll try this again. Is equal to, oh, I forgot to put the word sum in probably. Anyway, the reason that I am subtracting out all the current assets, including cash, for 2014 from the 2016 is if I go, they went up. So to reverse the asset effect, when assets go up, you always subtract out from the statement of cash flows. I just reverse the years. Okay, and that's going to be minus sum of all the current assets, non-cash current assets for 2016, and the change in assets is not including cash is minus 117. Now what I'm going to do is, I'm going to do this in parentheses maybe, is I'm going to add the total current assets for 2015, the total current liabilities for 2015 minus 2016, excuse me, this is 2016 minus the total current liabilities for that number right there. And what I'm doing is taking the negative change in assets, I reversed the year, so I reversed the effect. But we know that liabilities go in the same direction, and I can use the totals because it doesn't include cash. So that should give me the right change in working capital. And I got a negative 303 there, which it might seem correct. Make sure it doesn't include current assets. And so I've got an increasing amount right there. And what's happening here is my assets are going up, which is subtracting out, but it's more than offset by the change in current liabilities. Anyway, if it's not correct, we can always change it. Then we've got free cash flow to the firm. Okay, and free cash flow to the firm is simply going to be the sum of net income, working capital change, and capital expenditures. So this is going to give us 20,257 there. I'm stretching this out. Notice, like I said in class, notice how the income is dominating all the other changes. Okay, and the thing is, most of this firm's investments go to R&D, which is not capitalized. It's expensed. So if you did capitalize, your net income would come down and your capital expenditures would increase. Okay, now we're going to go for our valuation. We're going to go for our valuation. And the valuation, we're going to have a super growth period. I'm just going to bring down the assumptions for each period here. Okay, our super growth period, I'm going to bring these things down here just to get these assumptions in. Okay, so our valuations, we've got a super growth period, and our growth rate for the super growth period is 5%, 15%, and the cost of capital, which is obviously way too high. I don't know, there's a lot of risk in the market now, so is 8%. Okay, and we'll do the valuation for the super growth period first. Okay, and for that part of the worksheet, we are going to have the same format that I used before. Okay, so I'm going to make a little table here to value the super growth period. I'm going to put year. Okay, and I'm going to put I'm going to put 2016 here, and then I'll reformat in a second. 2017, 2018, 2018, 2018. Yeah, it's just going to be strange. 2019 and 2020. Okay, and well, actually, those should be going in the other direction. Sorry. Okay, so my year is actually going to fall into here. It's going to be my year. And so I got 2016, 2017, 2018, 2019, and 2020. Okay, and I'll reformat this one because it's not dollars, it's a year. Okay, so reformat the thing. Number there. Well, it's got a column, but it doesn't matter. Okay, so first I've got my year, then I've got my cash flow. I've got my cash flow, which is going to be just the free cash flow for that year. And then I've got my discount factor. And then I've got the present value of the cash flows. Okay, so the cash flows are just going to come down from, it's going to be your free cash flow for each year. And unlike the other model, the short model, there's more flexibility in this model. So for each one of these years, there's your free cash flow to the firm. Your free cash flow to the firm. And have this number right here. Okay, so you got your free cash flow to the firm right there for all 5 years. And now that I remember, the years become a bit difficult, I don't know why, but we've got to make these 1, 2, 3, 4, 5. And year one is 2016, this is 2017. And the reason is that we've got to use these numbers 1 through 5 for our discount factor. Okay, our discount factors are going to be equal to 1 divided by 1 plus the cost of capital. And on the bottom, it's going to be raised. When you raise something, you use the caret raised to the 1 here. Okay, so our discount factor for the first year is going to be 1 plus the cost of capital raised to the 1 divided by 1 plus the cost of capital raised to the power of 1 there. And what we've got to do here is we've got to put dollar signs in that cost of capital. Guys are going to extend all the way down. So we get 0.925 right there. And then we'll go ahead and see if we can get those formulas down there. Those look good. You can play around with the cost of capital too. And finally, the present value of our each cash flow is just the cash flow times the discount factor. Here's the present value of the cash flows for year 1. And then we'll just take them down to that right there. And we're going to go ahead and sum those up. And this gives me, this is the present value of super growth period. And now we're going to go down to the terminal value, which is year 6, and I'll just put ... for beyond, so it's for year 6 and beyond. Okay, and we're going to use the same, I'm going to bring down my assumptions for the terminal value. Okay, first of all, we had a growth rate and a cost of capital for the terminal period. We'll get these down here, copy those down there. The growth rate, I think, was 2%, and the cost of capital is 5%. Might as well get those right. Growth rate was 2%, and the cost of capital is 5%. So we got the cost of capital is 5%. 5%. Guess it's giving me bad formatting again. So it's 5%, you know. And I'll just do this as a number, 0.05. Okay, that's fine, 5%. Okay, I just wanted those assumptions in. Okay, and we're going to do the numerator. We're going to use the Gordon growth formula again. We're going to use the numerator. Almost done here. I want my computer to run out of memory. So this is going to be our numerator. And we're going to use the denominator. The numerator is going to be my cash flow at year 6, okay, which is going to be my cash flow at year 5 times 1 plus the growth rate, which will give me of 2%, which will give my cash flow there. Okay, so this is, if we put times here, I think that'll fix that. Let's get this right. This is equal to that times 1 plus the terminal stage growth rate. That'll give me my year 6. So this is year 6 cash flow. That's what's in your numerator. And I'll go ahead, and our denominator, it's just going to be the cost of capital minus the growth rate. That's the Gordon growth formula. Okay, and so when you divide the numerator by the denominator, you're going to get this is going to be the, I don't like Excel sometimes. We're going to get the terminal value at year 6. Okay, so the terminal value at year 6 is the numerator divided by the denominator, and that gives you a rather large number. Okay, but that only takes your terminal value. That's at year 6. We've got to discount that to the current period. So I'm going to use the 5-year discount factor. The 5-year discount factor. Okay, so the 5-year discount factor is this number right here. So if I take my terminal value at year 6, I'm going to try to format these fairly well here. So these are dollars. These are pure dollars. A currency, that looks good enough. And we'll do the same thing for this one. Format cells. It's currency, dollars. You got that one right there. But that's terminal value year 6. We've got to take it back to the present. So the present value of terminal period is going to be that number multiplied by the 5-year growth period. So the terminal value of the growth period is 829,109. Okay, and so the value of the firm, I'm going to say value of the firm is going to be the sum. This is a subtotal. Is going to be the sum of the super growth period plus the terminal period. That gives me about 936. And I'm just going to divide that by the number of shares. I want the number of shares, and I'm just going to use whatever I used up in my earnings per share formula calculation. Go way up here to the income statement. No matter which one I take. I use 1464 shares. Okay, so if we take the value of the firm divide by the number of shares, we will get, which would just let me finish, value per share is equal to that number, the value of the firm, divided by that number. And I get about $639. I've been getting in the 600s all day on this thing. So that's the bottom line here. It seems a little bit high. There's ways that you could probably get the number down a bit. And probably the thing that's really overstating this number is the fact that they're expensing all the R&D. Okay, so you could make a model. Maybe we'll do this for next week, and we'll have a short week for next week. But you could make a model where you actually capitalize a portion of the R&D. You could just assume a percentage and capitalize a percentage of it. And so that would mean that not all R&D was being expensed, which drives down the income. And actually expensing R&D capitalizing it would actually drive the share price more up. So this is what I've been getting, and the whole thing is based on these numbers right here. It could be affecting your free cash flow. If you were capitalizing your R&D, you'd have greater capital expenditures. So that could affect this to some extent. And they have tons of R&D, so that may be driving the price up because you would add it back here. They're taking out of here, but you would add a portion of it back here. So that would increase your free cash flow to some extent. That's probably why it's high. Also, the final question is, it seems to me that this company may be coming into something here. And so I'll throw everything out in an email for everyone. Okay, so everyone stay well, and I'll be in touch. Bye-bye.